welcome to the meetup tonight, and it's a pleasure to have everybody here. We have several newcomers, so I typically like to start off things by with introductions. And so my name is Bobby Jones. I am the organizer of this meetup. I am a retired nurse anesthetist turned apartment investor and alternative investor, and so this meetup is meant to help people kind of find their own way within multifamily and alternative investing. So whoever else would like to introduce themselves, we can. I notice everybody is still on mute, so let's see. And Jaquez, you did tell me earlier you're kind of at dinner right now, so if you want to just type something out in the chat to introduce yourself, that's perfectly fine too. For those of you who don't want to talk, but Vishnu, if you want to go ahead and introduce yourself.
Hey, myself Vishnu. So I'm a newbie. I'm just looking around for single family homes, and also I just came to know, like, instead of single family homes, multi homes is much better for investing. So I just joined this meeting. So this is my first or second meeting on Meetup. Just getting started.
Well, great to have you. Thanks for joining us tonight, and hopefully we can kind of go over some of those differences between single family and multifamily for you, and help you make that decision. So
sounds good.
So Wendell, if you want to unmute and introduce yourself, if you don't mind.
Hi, this is actually Shannon, Wendell's wife.
Okay.
We're both on the call. Basically, we are completely brand new to this idea and just wanted to see what it's all about.
Okay. Sounds great. Good to have you here.
Thank you.
So, and then Patrick.
Thank you. My name is Patrick, and I am also a new on this idea, and I love to learn more and how to invest on apartments. Thank you. Great.
And Maricela, I know you kind of spoke earlier, but if you want to introduce yourself real quick too, that'd be awesome.
Awesome. Thank you, Bobby, for having us here. So lots of new people, which is amazing. I absolutely love. We both love educating and just getting to know new people and see how we can help. But pretty much we started with a small portfolio, grew it to 35 doors, and then transitioned now to joint ventures to include mobile home parks and self-storage. And currently we are passively invested in 1,250 units and across 5 different states. And we are currently general partners, which are syndicators for 2 complexes over 350 units in Houston and Austin. And currently under contract for a property in Florida, 51 units, and an accepted LOI, negotiating a contract for a 200-unit apartment complex in Dallas, and 2 more on the pipeline for now. But that's kind of the short summary. Both of us are veterans. We did all this transition within the last year. So it might sound like a little overwhelming, but I assure you guys, new brains, it's very doable. So we're happy to help in any ways we can.
The small multifamily growth was from 2017 to 2020. So in 2017, the beginning of 2017, we had 3-4 doors between us. So you can grow as fast as you want and in whichever direction you want.
Yep.
Yeah, it really is pretty incredible what you can do. And Sophia, I saw you come in, and all we're doing is kind of introducing ourselves. And so if you wouldn't mind just unmuting and let us know who you are, where you're from.
Hi, everyone. My name is Sophia. I live currently in Raleigh, North Carolina. I am a complete newbie. So the complete opposite of whoever was just speaking right now.
Yeah. No, that's great. It's good to have you here. And, that's kind of what this meetup is for people who are, really kind of starting out and, not sure where to go, not sure how to do this. One of the things that is often talked about is, you know, how many people will get started in single family and they feel like that's how they have to get started in order to get into multifamily and to eventually build up to that. And that's really kind of a misnomer. You don't have to do it that way. You know, so it's something that, you know, I did. I bought one single family home and decided it wasn't for me. And then I was able to start investing passively in apartment syndications. And so apartment syndications are basically a setup where investors pool their money together to purchase an apartment building. And so that's really what it's about, is you know, pooling those resources together. Maricela and I are a little more on the active side now, where, you know, we're actually a part of the management team that goes in and handles the property once it's purchased. But you know, the idea in general is that you can invest your money into an apartment syndication and receive passive income and returns as an investor. And so, you know, that's something that is great for anybody to be able to get into. There are, you know, the main requirements are the financial minimums for a particular deal, but you know, that can be anywhere from $25,000 to $100,000. But in general, you know, that's kind of where your range is for getting into certain deals. But I'd love to talk a little bit more about, you know, the basically the overall structure of apartment syndications. But I've got somebody who's messaging me, and I have to let them know how to get into the meeting. So I'm going to do that real quick. So if let's see here. This is my buddy Don trying to get in. So good deal. All right. So yeah, basically the great thing for investors is that it is one of those forms of investing that is truly passive. So you get the advantages of having an economy of scale. So instead of buying, you know, one or two single family properties, and they either, you know, are somebody's there and you know, renting the place, or they're not, either you're making money or you're not. If you have a 100-unit building that you're a part of an investment on, then essentially, you know, a few units not being rented is not going to hurt you. So you automatically buy into a certain economy of scale, which is nice. You don't have to worry about all the calls and things like that in the middle of the night. If you're trying to, you know, you don't have to worry about self-managing the properties, things of that nature. So Don, welcome to the conversation.
Thanks.
Everybody's kind of introduced themselves. I'll let you go ahead and introduce yourself as well, Don.
All right, thanks. Yeah, I apologize for being late. I was jumping off of Yona's meetup and couldn't get the link to work for you. So, so yeah, my name is Don Spafford. I'm in Idaho Falls, Idaho. I've been investing in real estate in general for almost 5 years now. Started with some small multifamilies, going with fourplexes, and then you know, started to want to scale up, as most people do. I've got a couple of development projects going on now, and looking to continue to scale and you know, meet up or get to know other potential partners and start doing some larger multifamily deals together.
Yeah, and Don, to kind of give you a feel, several of the folks in the room are brand spanking new to the idea of multifamily investing. So we're just kind of going over some of those things. If you guys have questions, you can either put them in the chat, or you know, we can you can just say them and we can have a conversation about it, you know, because you do have some good resources here between myself, Maricela, and Chris and Don to answer, you know, questions for you about apartment investing. But or you know, obviously Don's doing some single family development too, and multifamily development. Is that right?
Yeah, multifamily and commercial.
That's right.
So we're doing like 800 condos, townhomes development, then a triple net lease commercial development as well.
Mm-hmm. So lots of people here with some good experience. But a little bit about my story. As I mentioned, I'm a nurse and anesthetist, but I am retired. Part of that is because I was able to produce enough income with apartment investing to walk away from my job. And you know, so I had a need to be a stay-at-home dad, And so we were able to do that. And so it's been a couple of years now since my apartment investments have been going, and it can get pretty powerful after a while. So I had 2 of them that just went full term this month out of my now 7 investments. And so those investments, when they go full term, then you can 1031 exchange them into future projects and continue to, have that passive income coming off of them. So I'd love to get some specific questions from anybody, because I know I feel like I'm bouncing around a little bit. So I want to try to nail down some stuff for you and get your questions answered.
Hey, Bob, this is Vishnu. So how exactly did you get started?
Okay. Yeah. So basically I got started by listening to podcasts, and I was listening to Bigger Pockets, and they had a guest on by the name of Michael Blanc. And so I started listening to Michael Blanc's podcast, and he had a guest on by the name of Ryan McKenna. And Ryan McKenna operates an equity firm that basically matches up investors with apartment syndication opportunities. And so that's how I got into it initially, was, through my networking and reaching out to Ryan McKenna and investing in some of the projects that he had. So I got on his email list, and then I'm able to, see the projects that he has. And so that's something that, you can get on various sponsors' newsletters and be able to see the opportunities as they come across. So I know Maricela has a monthly newsletter, and she just put it in her information in the chat. So make sure you check that out. And I'll put mine in here in a minute, but yeah, it's something that, basically you find the management team, the sponsor team that is going to bring investments to you, and they're seeking investors to invest in these projects. And so you are basically investing in the sponsor group, which is what's really important with multifamily investing, is to know your sponsor group, because they're the ones who are carrying out the business plan for your investment. So I compare it to like if you bought stock in, say, Amazon or Facebook. If you buy a stock, you don't all of a sudden walk into, Jeff Bezos' office and start calling the shots, right? Like, you're a passive investor when you invest in stocks. Generally speaking, you're investing, and then the idea is that your investments allow a business to carry out their business plan. This is no different when you're buying an apartment complex or buying into an apartment syndication. They're buying a building, and they have a business plan for increasing profits. And so a lot of times that involves some renovation work to update the units. A lot of times they're identifying properties that maybe the management hasn't increased rents as much as they could have or should have. And there are a lot of different ways that the management team can increase profits, decrease, the expenses, and ultimately make it, into a good investment for you. So that's really who you're investing in. As much as it's nice to say, well, I've got, properties here and properties there, and, however many doors and stuff like that. I mean, it's also something where you want to invest with good people, because they're the ones that are taking care of your money. It's not always about the actual property itself, which is different from single family. The single family mindset is, a lot different than the apartment syndication mindset.
Right. So during last meet, something else, I met with those guys, and they said like they are a group of 35 and they don't allow any other people to join with them. So I was just wondering, for our newbies, where exactly to get started with? At least I got some idea right now.
Yeah. So, and like I said, I have actually an educational email series that, I've developed. And so if you get on to my newsletter, you can get this email series. It's free, nothing, it's just something that kind of walks you through some of the nuts and bolts of apartment investing. And, that way you can actually start to really learn the lingo and, understand more of the concepts involved with it. So, if you want to just shoot me your email, I can get you onto my investor list. And you can put that into the chat if you want to just send that directly to me or however you'd like to do it. So, let's see here. Yeah, I need to. So the question is, what is the minimum amount of cash you need to invest for overseas investors? So that is, it just depends on the deal. But basically, whether or not you're overseas doesn't make any difference in the amount that's required. It depends on the specific deal itself. So I just had a self-storage offering that I looked over, and the minimum for that one, it was going to be 25,000. Most minimums for apartment syndications are 50,000. Some are, like I said earlier, 75 to 100, but those are typically with operators who have a lot of demand. And so, that's, they have good investments for sure, but they increase that so that they don't have to deal with as many investors. Whereas some of your other deals, it's not a big deal for them to take a lesser amount. But I would say, roughly speaking, you need to have about between $25,000 to $50,000 to really start thinking about getting into passive apartment syndication. That being said, that's not the only way to get into apartment investing, as Maricela and Don can attest to. You can get in on the active side, and, there are different roles that are on the management teams. And so that's where networking, coming to meetups like this and meeting people, figuring out what it is that you're good at. Are you, what is it that kind of motivates you and what you're interested in with being a part of a team? Because everybody's a little different. There's some people who are very numbers oriented and they want to underwrite the deals, which is, basically finding a property and doing the number crunching to make sure that the deal is going to work. That's what, that's the definition of underwriting. So if they're doing that, then you need somebody else who's actually going to be more of a property management and, stuff like that. So you may have somebody who's more of an operations manager. You may have somebody who's really good with the broker relationships, and they're always, talking with the brokers, and that's really where you can start to find deals, because most of these deals that happen, it's not like, in single family where you can go on to, Zillow or whatever and find a listing for a home and, okay, well, I'm going to go buy that house. And, these are more off market deals that happen based on relationship building between brokers and syndicators. Anybody have anything else to add to that?
I can interject a bit, kind of like what Bobby was saying earlier. I mean, if anybody that's new here hasn't already signed up for Bigger Pockets, that's a great place to start. I do definitely myself get all my initial education from there, listen to all the podcasts, webinars, read the books, and then that's kind of what got me the motivation to want to learn more and start getting started, because getting started is the hardest part, just to get started. And whether it be, doesn't matter, condo, single family, multifamily, doesn't matter. It's just, get the motivation to get started with something, just get that experience and motivation to continue to grow and learn more. And that's what really gets you going. And then from there, just continue reading books. There's plenty of books out there about any type of real estate, any asset class, any way of doing it. So there's plenty of stuff resources to get a hold of to learn, and and then just start going to networking events like this to get to meet more people and learn from them and find ways to work together. Like Bob was saying, if you don't always necessarily have to have money, if that's your factor for not investing, so you don't have the money, there's people that have the money. You can offer some other thing like your time or resources to find a deal and make it happen. So there's many different ways you can get involved for sure.
Mm-hmm. Yeah, and I love the saying that you need to have, you can either have hustle, money, or knowledge, and so you need to have at least two of those things to kind of make it work. So if you don't have money, well, then you need to be educated. You need to have some knowledge that you bring, and you need to be able to hustle, and put in some sweat equity with whatever it is you're doing. So that's really where, that those kind of things can make a big difference in whether or not you're able to kind of get moving with it. But yeah, go ahead.
Sorry, Bobby. Sorry to interrupt.
No,
I was
you're
just gonna
fine.
add to everything you guys have been saying. Like I mentioned earlier, I am like completely new. Just started trying to research and learn, and like most people here have started with bigger pockets in their podcasts, and I'm trying to read as much as possible. Network. I just recently joined my local RIA. I'm trying to do some volunteering work in there. I think that would be a good place to start.
Mm-hmm.
And so I have not really researched syndications at all. This is literally the first time or the first meeting I'm attending regarding the subject. I've been convinced so far that the BURR method is the way to go.
Mm-hmm.
Again, it seems like it's trending and it seems so beautiful on paper. I'm pretty sure it's completely different in real life. But my question to you, like everything else, right?
Yeah.
My question to you is, say I'm just a number, whatever, like $200,000, right? Right now, from what I've been hearing and reading and all that, I can put that $200,000 towards one property or two, BURR those properties, and then do it all over again, and then keep doing so until I build a good sizable portfolio. Because my goal, and we all have to have like the why. My why is I just want to build a sizable portfolio that I can retire comfortably and just leave for my kids, right? I'm not really interested in the cash flow. Cash flow would be great. But my ultimate goal is generational wealth and a good, comfortable retirement. If I go the syndication way, am I saying that right? Is it syndication?
Mm-hmm. Yes.
Okay, so with $200,000, I can see myself buying a property, rinse and repeat until I reach my goal. If I put that $200,000 towards what you did, I guess, what is the return on investment, or do you need a lot of money in order to see a good profit? Did you start with nothing? As far as obviously it's not nothing. Did you start with a small amount of money, or did you have to start with a big chunk in order for you to retire like you did?
Yeah. So basically, and I'm not the usual story. So, take this as you will, but I decided to go whole hog. And so I took money out of my retirement accounts, and because I wanted to produce cash flow now, and I had the money that was sitting in these retirement accounts. I'm 41 now. I was 39 when I made this decision. That money I wasn't supposed to be able to touch for another 20 years, but my thought was, well, it can still grow in investments, and it can actually be producing income for me now to allow me to, buy my time back. So I did have a chunk of money that I put in. Now, one of the things I want to touch on, because you mentioned the BURR method. So a lot of times syndications are just like the BURR method, only it's on a bigger scale. So the general idea is that you're buying a property that's either been mismanaged, or it's got some deferred maintenance on it. You go in and you're fixing up this property. You're putting whether they may have vacancy problems, so you're making sure that you get the word out and you get more renters in, and you're boosting the value of that property. And the difference between single family and multifamily is that the value of multifamily can be directly drawn from the profits that it makes. So, your house, your house fluctuates in its price all the time, based on your local market and things like that. The price for multifamily is derived from the profits that it makes, the net operating income. And so that's a big difference. But going back to the BURR thing, Essentially what syndicators want to do is they want to come in, purchase a property, fix it up, and then they'll do a cash out refi and get you some of your money back after a couple of years, if that makes sense, or they'll sell the property. And so that's the general idea. So when I said that 2 of my properties were going full term, these were properties that were bought, within the last 2 years by, a syndication group, and they have gone in, done kind of their fixing up, and then instead of refining, they were actually able to sell the properties at a profit. And so when you talk about your returns, that's something that when you see a deal that comes across your desk, a lot of times the returns are going to be, I want to say around, between 12 to 18% per year. Now that doesn't obviously you don't get all of that each year. It's all kind of marched out in certain ways, depending on how the deal's drawn up. But the general idea is that, what they're looking to do is try to double your money within 5 years. And so that comes out to around 15%. That's kind of where most of these investments range. That being said, the 2 investments that have come full term for me, one of them had a 1.7 equity multiple. The other one had a 1.8 after the end. Thank you, Maricela, for putting that in the chat. So that's a perfect explanation. So, but yeah, so that's something that, I've nearly doubled my money in 2 years with those investments. So they figure, well, if we can sell the property, get you your money back now, then you can go and put that into another deal and continue, the process. So does that make sense?
Yes, it does. And then thank you. I was reading the chat, what Marcella just put in there.
Yeah. So
it sounds good.
Yeah. And that is what they do. They try to pay you in distributions along the way. So you can see distributions anywhere from 6 to 10%, per year that you get. So, if you invested $100,000, you could expect $6,000 to $10,000 in distributions over the course of that year. And so they do that, and then you make up the rest of the return on the sale of the property.
Awesome. Yeah, I didn't know that it's something that they have to go and actually force appreciation in a way. I thought they just buy pretty homes and then just rent them out, and you're an investor for life. But thank you. I had no idea, like I said.
If only were that easy. Right?
I know, right?
Yeah, no kidding.
Can't you tell I'm a newbie?
This is very exciting. Like it's great to see all these great questions. I'm just going to briefly offer. I wrote a book that is a comprehensive, pretty much guide. What do I have? Do I have time? Like Bobby was saying, do I have time? Do I have resources? Do I have knowledge? Do I want to do hands-on? Do I want just to be hands-off? And then based on that criteria that you pretty much kind of self-select, then it gives you the strategies on suggestions on 2 or 3 type of assets that you could be a good match with. It's on sale as 99 cents, but if you guys put your emails in the chat, if that's okay with you, Bobby, we can gift that to you guys. It's just to kind of give you a broad idea. And at the end, I actually do talk about how to become an educated investor when it comes to passive investing and syndications. It goes all the way to the very basics. So what is the syndication? How is it formed? Who can be invested in, and all the regulations that go along with it. That is a PDF, or we also have that information on our YouTube channel. So if you visit our website, there's lots of free educational material. But if you also want to connect with us, we'll be happy to be on the call with 30 minutes each, or hopefully maybe recurrent sessions if needed. But lots of free material out there. You just need to, you are doing all the right things already. I hear some people already listening to podcasts, reading books. Networking is a huge, like you cannot, it's just, that's what you get, pretty much the solidification of the information, and you get the motivation of hearing stories of people that have done what you want to do. And that's the environment that you want to surround yourself with, people like that. But yeah, it's great questions. Love the fresh minds here.
Yeah, this is really cool. That's the thing is, like, when you first jump into it, you don't know even sometimes what questions to ask. So, it's great that, everybody in here is asking some really good questions. And yeah, and Maricela, you've got some great resources there too. I have to commend you and Chris on that. You guys have done a fantastic job with that. So, but yeah, man. So, let's see here. So Maricela, you said you've got something that you guys have been working on. So tell us a little bit, if you would, about how that process has been, how you built those relationships and how you worked on that.
We pretty much, this partnerships came about being part of masterminds. And these are paid groups where we gather weekly or sometimes several times a week, and pretty much, collaborate and find partners, find deals. This specific one, it's a partnership in with the primary person. She found the deal, and then she found us as partners, and then we found all the capital partners. So it's 4 general partners, 4 GPs, and then this specific one, because it's a 506B, we can. I'm sorry, but sorry, yes, C, which means we can actually talk about it, even though we don't have a previous relationship started, except for Bobby and Don. So yeah, it's that's pretty much how we found the partners. Again, if you team up with people that are continuously underwriting and looking for deals, then you don't have to do that as heavily, because you can count on the partners to do that portion. And then, like in our case, we do a lot of the asset management and finding those connections for the vendors that are going to help us manage the property. And what else, please?
So the 506C it also requires the investor to be an accredited investor, meaning they have at least a net worth of $1 million, or they make at least $250,000 a year as a single person, or $300,000 a year as a married person, between them. Like she said, the 506C is an open advertised offering, just like stocks and stuff like that. It's all SEC regulated, and so we'll be sending out stuff in the near future here when we've got all the legal paperwork taken care of and put together on the project. This one's probably going to close in January. It's for the process for that one. It literally was the partner went, saw this property being worked on, talked to the builder. Hey, when are you guys looking to sell? Are you looking to lease it up first? What do you want to do? And there are some people that will specialize in this type of project because they can get things cheaper than if they wait for it to lease up. And it'll take 5 or 6 months to lease up even 50 units. It could take 4 or 5 months. Mm-hmm. And so for those couple of months, you're not going to have any cash flow, and there won't be any dividends sent out to investors. But what we'll do is, we were talking earlier about that 6 to 8% cash flow each year. We will offer what's called a preferred return. That means you're guaranteed. I can't say guaranteed because nothing's guaranteed, but the projection is that we will pay 5% every year. As long as the property cash flows, the debts will get paid, and then that 5% will get paid out, or 6% will get paid out to the investors. And then anything that's left over gets split between the general partnership and the investors to provide a larger return to you. Anything I missed on that, Bobby, that you can think of? I
think you got it pretty good. Now, and a lot of times you can blend how you invest as well with different offerings. So if you want the preferred return, which is in theory, it's less risk, less reward, and versus the non-preferred return. So basically you can, if you've got $50,000 to invest, then they would let you potentially put in, 25 here and 25 there, and then you can kind of blend your returns a little bit with those. But that's something that, I do think is a pretty visual concept. So I did want to put out there that I do have a lot of education on my YouTube page. So if you guys wanted to check that out, I put the link in the show notes. Basically, so Don, you've got these different development deals going on. So what's it been like on your end? How have you built these relationships, and how'd you get these things rolling?
Sure. Well, to just kind of go back on what we were talking about before, how we got started. So again, going back on the bigger pockets education and learn my why and whatnot, I came to realize that multifamily was definitely the way to go for economies of scale and different reasons. So I skipped the single families, but I obviously wasn't ready or didn't have the connections to go into like an apartment building. So I bought a fourplex, so it's technically still considered residential. So I got a fourplex for my first property, which I actually found on Craigslist at the time, for sale by owner. But again, going back, I didn't have a huge amount of savings. I didn't have like a 25% down payment for this, and at least not my savings. We had very, very little savings. I'm not a high income earner for my job, but I did discover some creative financing methods. And so I found a local bank lender that does 10% down payments on investment properties. So I was able to go for 10% down instead of 25 like normal. And I discovered that I could borrow for my 401k. So I took out a loan for my 401k for most of that down payment. And people might tell you, that's you don't ever touch your retirement account. That's for your retirement. You don't mess with it. And but as long as you don't withdraw from it, that's completely different. You get taxed heavily on that, but you can take a loan out anytime. And in the time period that I had that loan out for my 401k, my 401k was probably earning maybe at most like 10% or so per annual return on it. Whereas the property I purchased, I now get about say $12,000 a year in just in cash flow, and then plus it's appreciated by like about $200,000. So I've definitely way earned my income from that $20,000 loan for my 401k much far better than what it would have done in my 401k. So I'm definitely not regret that at all. But going back, so I started that first property mainly because I knew that I needed to get started. I learned that you need private lenders and other investors to build the do deals, but none of them really want to lend you money if you don't have any experience at all. So I was like, okay, I need to get started no matter what. I need to find property, and so I got the fourplex, and pretty much right away I was like, okay, now I've got some, technically, experience, right? I'm an investor. I have a property, so I can now start networking more people and say, yeah, I'm an investor. So I started going to some local meetups, and honestly, it wasn't even too long after that I actually found a local lender that I talked to and met with, and he was actually willing to invest $1 million on a project I was trying to do at the time. At that time, we were trying to do a development project here as well, but didn't end up working out for different reasons. But one of the first things he asked was, what's your experience? Are you an investor? And I was like, yeah. I was like, I've got a fourplex. It's not much, but it's something. I was like, I've held it for a while. I've self-managed it, and that was good enough for him. So. But just over time, I've been building those relationships on being active. First of all, being active on bigger pockets. I'd start asking questions myself, and then eventually I became knowledgeable enough where I was answering questions. And so people see me on there a lot, and people would actually, they're looking to for example, invest in Idaho, for example. They'll search up Idaho, and my name comes up, so they always then contact me. He's like, hey, I see you're pretty active on here. You know your market well, and so I'm like, yeah, sure. So I help answer questions, and my wife's a realtor as well, so that brings a lot of business for her as well, for any out-of-state investors looking to buy here. So I kind of quickly on there became essentially like the local expert, for real estate investing, and then it was, I think, through some of those connections on bigger pockets, some of the guests that are on there that I connected with, and which another thing I suggest, anytime you hear a guest on a podcast, don't just listen to it and say that was awesome. Reach out to those guests and say, hey, they almost always leave a contact information. So I did that almost every single time. I'd try to contact them and send them an email, nothing else, just to say, hey, I enjoyed your podcast. I love this you said. I've got this question about this, whatever. So most of the time they're happy to respond and help with that. And through those contacts, I met with somebody that invited me, I think, to come to some other meetup event or something, and that got me pulled into LinkedIn, which I'm much more active on LinkedIn. I think quadrupled my contacts on LinkedIn just since this last June, mainly just for going to these meetups and different people I've met. And yeah, so I go to these networking events now all the time, and I meet people like Bobby and Maricela, and get to network with more people and learn from them, and eventually do some deals together as well. Because honestly, you can't expect to get into any deals with like a joint venture or the partners if you're not putting yourself out there and being actively involved and talking to people. It's they're not just going to come to you. You got to do your part and at least be active enough to network and talk to people and tell them what you're looking to do and what ask questions. People like us on here now, we're all happy to answer questions and help people starting out new. I started myself a blog a couple years ago, kind of more about personal finance, but it also talks about real estate, and kind of for that reason I'm looking to help people that are just getting started that don't know what to do or need help with their personal finances or whatever it may be, and just to get that kind of advice. And I was on a call earlier today with a young woman in her 20s looking to get started in real estate. Had no idea about anything. She was on another meetup event like a couple weeks ago, and saw my post on LinkedIn after that, and contacted me afterwards just to ask questions and find out more. And so I'm always willing to help as well. So that's kind of more, I said, what really got me started, and just from these networking with people kind of pulled me into the bigger things. So these development deals I'm on now would not have happened if it wasn't for doing those networking and talking to people. It's just kind of a long chain of events that led to it. Meeting different people that referred me to other people, and here I am now on these development projects that when I started 4 years ago, I would never imagine that that's where I'd be. I started 4 years ago with my first property, and I'm looking to get the scale where Maricela's at, but I know I'll be there soon. Just the way things go, getting started is the hard part. After that, it's just it takes off. You start building momentum, and things just continue to grow and compound, and eventually you're doing things you never would have thought you could have ever done.
Yeah. No, and that's the truth. I mean, it kind of ends up being a chicken and egg problem a little bit at the beginning, because you want to get the experience, and so you want to get in, and have a property or something, and the banks say, well, we're not going to lend to you because you don't have experience. It's like, well, how do I get experience if you're not going to lend to me? So, but yeah, and the other thing too that I thought was important to point out is a big difference in single family and multifamily is that, with single family, you basically can take this on and you can build your own portfolio by yourself. I mean, certainly you're going to have realtors, and, if you're doing the BURR method, then you're going to need to have people who are if you're not doing the work yourself, you're going to need to have teams that come in and do the construction work. But, essentially it's on you. And so it's a very single-minded kind of thing, like you're building your own portfolio. Whereas with multifamily, it really is a team sport. And that's where the networking stuff comes into to being so important. I've been going to meetups for, a couple of years now, and some of those relationships that you build over time, they take time to come to fruition. So, I could go out and, probably talk to a bank and go buy a rental home, in the next month if I wanted to, but it's a little different with multifamily. And sometimes it takes a longer amount of time. Sometimes you jump into it and you find your team right away, and it works out beautifully. But even people who, there's all kinds of coaching programs out there where you can, spend money to learn. And there's a lot of value in that. I haven't taken that route. It's something where I've been willing to just take my time with building my company and building those relationships. But you can fast track those things by getting into some of those masterminds and paying for coaching, but you just have to be very selective about, the coaches that you're choosing. I would encourage you to talk to people who are already in those coaching programs to really get the gist of what that program's like before you jump into it. So, but that is one way to fast track, results is by getting into some kind of a coaching program, but you have to pay for that. So, just something else to keep in mind. Any other questions, guys?
Hey, Bob, one
Yeah.
last question. So in single family homes, you get tax benefits. So how that works in multi-property?
Oh, tax benefits of multifamily are wonderful. So there's a couple different ways that this works. Basically, you get depreciation just like you do in single family, okay? But a single family residence is basically you space that out over 27 and a half years, I think it is, or 20.
Right, 27 and a half.
Yeah. Whereas in multifamily, you can benefit from a couple of different things. So when a group goes in and they purchase a building, they want to go through and do what's called a cost segregation analysis. And so basically they have a professional come in and take a look and say, okay, well, the roof is, new, so we'll depreciate that over 20 years. And then we've got carpets. Well, carpets only last 5 years, so you depreciate that over 5 years. So they go through and they do everything in that apartment complex and really break down the depreciation schedule for it. And so that allows you to get K1 statements, that's a tax statement. But basically when you invest, you get a K1 statement that shows a lot of paper losses for you, because what they also do is they have what's called, bonus depreciation. So you can basically move all of that depreciation up and take it in the first year that you invest. And so that does actually really help people, particularly with, if you've got a lot of passive income that you're trying to shield, that can help you shield that income from taxes. So it doesn't work on active income, so it wouldn't really help your W-2, but it can shield the profits that you're actually making on your multifamily property. So if you're getting those, distributions, and you have this big K1 statement that says you've got all these paper losses, those paper losses will shield the passive income that you're producing from that investment. So it's pretty powerful. And yeah, Maricela, you have raised your hand.
Sorry, yes. So
We love taxes, by the way. We paid 0 taxes.
Yeah.
she's rubbing it in now. So with the cost seg, all that bonus depreciation comes to year one, and the way that we explain it to our investors is that's basically sits on your IRS tax statement as a piggy bank. So as we give out the dividends each year, that's 6 to 8%, you get that income without increasing your tax burden because you already have that negative piggy bank. So if you don't have other rentals or other passive income, it just sits there and waits to get used. And then when we refinance, that's a non-taxable event where you're going to get a return of capital. And when we sell, you'll have more technically taxable income, but that negative K1 is still sitting there with money left over usually. So if the deal says that they're going to double your money in the lifespan of the deal over 5 years, then you will have doubled the money that you invested in the project and never paid any taxes if there was 100% cost seg. If it was 100% valued back on that K1 in year one. If it's only 80%, okay, you doubled your money and you're paying taxes on 20% of it. But guess what? When we refinanced, we gave you back a portion of your capital. You can throw in a couple more bucks, go into another deal, you get another negative K1, and it just perpetuates that growth for you without increasing that tax burden.
Yeah. So this is where you really start to get into, the overall benefits of investing in multifamily, because it's not just the returns. A lot of people want to focus on the returns, and that's great. The returns are great and they stand on their own, but you're producing tax protected income. And that's one of the big things about it, is that you're able to grow your wealth in a tax preferred status, and instead of having it be like your regular income where you're taxed on it, in any benefits. So when you have a property that comes full term and they sell, you can do one of two things. You can either take all those profits out and then you can, pay capital gains taxes on it, which are still lower than income taxes. Capital gains taxes, depending on where your income level is at already, could be zero, but I mean, it typically is between 15 to 20%. That's not anything compared to most people's income taxes. So you could do that, or you can do what's called a 1031 exchange, and you're deferring the taxes. And so you take that entire lump sum and you put it into another investment of, that's similar. You could put it into another multifamily syndication and just roll it over. And you've now deferred taxes. So you don't have to worry about any of the capital gains at all. And you can continue doing that until death. And then your heirs don't have to worry about paying any taxes on that once they receive it, because it's now at a stepped up basis. So, and I actually just did a video on this about the 1031 exchange. So, it's on the YouTube channel that I linked to, but yeah, the tax benefits are amazing in multifamily, and that's because the federal government is incentivizing people to invest in real estate, and that's a big reason why the tax benefits are what they are.
Cool. Perfect. Thank you.
Mm-hmm. So it's looking like it's getting close to 9 o'clock. Does anybody have any last questions or anything they'd like to say?
Hey, I'll just mention, I put my contact information here on your chat, probably at the top of the thing, but anybody here that does not know me, please connect with me on LinkedIn, or I guess I'm on Facebook too now. So you can find me there, and I'd love to, be happy to connect and help answer any questions as well.
Yeah, and if you
Don,
guys,
sorry.
go ahead. Go ahead.
I was just going to say, I already stalked you, Don, because you said the advice to follow up with whoever you speak to, or if there is a podcast, make sure to follow up. So I'm just, applying the advice already.
Okay, great.
That's
perfect.
Awesome.
Thank you.
Yeah, and that's what these things are all about. Is taking the conversations off of out of the meetup and into places where you can really learn from people. So. These personal relationships that you're building now are, they can pay real dividends for you in the future. So I encourage anybody to do that. And, you're looking to do a JV. Okay. I live in North Carolina. I'm trying to remember. Sophia, did you say you lived in Raleigh? Okay. Right. I'm in Winston-Salem, so we're not far away. Looking to do a JV in North Carolina. I don't want to butcher your first name. Feel free to unmute yourself and let us know a little bit more about what you're looking for in North Carolina. Oh, you're in Winston-Salem too. Cool, man. Good deal. So
are you guys part of any meetups, like in person, or like the NC RIA or anything like that?
Okay. He's at work now. I am not. I'm going to be, but COVID threw things out of whack for me and my family. So I have not been doing in-person stuff, and but that's going to be changing. My kids are getting vaccinated, and so I'm very excited. So so we got a couple people here in Winston. Very cool. So man, this has been great, and I've got some different people's information, and I look forward to connecting with all you guys. Feel free to reach out to me. We can set up a phone call or anything like that to, discuss how we can help each other out. A lot of us in North Carolina here. So, and that's a great thing about these kinds of meetups. So, but yeah, thank you guys. And, the other thing I was going to say is if you want to save this chat, all the information that's in the chat, so you can go and you've got all these links and stuff. If you go down to the lower right-hand corner of the chat, there are 3 little dots there, and you can click on that, and it will give you the option to save the chat. So I want to make sure everybody has a chance to do that before I end the call. So
you said the lower right hand.
Yeah. So if you hit the chat and it shows all the chat stuff on the side, it's the lower right hand side. There's 3 dots right next to the smiley face.
Got it.
So
Thank
yeah,
you
and
so
that way,
much.
that way you guys can save the information and you've got that to use at your leisure. So, but yeah, thank you guys. Thank you everybody for being on the call tonight. This has been a lot of fun, and yeah, please reach out to me, LinkedIn, wherever, and we can set up a call and find out some more information about each other. So, all right,
Yep.
that's gonna
Thanks,
do it,
Bob.
guys. Yeah,
Okay.
thank you.
Happy Thanksgiving.
You
Bye.
too. Yeah, happy Thanksgiving to everybody.
Happy Thanksgiving. Bye-bye.
Thank y'all.
All
Take
right.
care. Bye-bye.
Yep.
Bye.
See you guys. Thank you so much for joining me for another episode of the Plan B CRNA podcast. If you haven't already subscribed and reviewed the show, I'd be honored if you took the extra time. It really helps to expand our reach and get the word out about the show. If you're a CRNA who is interested in sharing your story on our podcast, I'd love to have you. Please email me at bobby@oncallinvestments.com for more information. This episode was brought to you by On Call Capital. They are dedicated to helping providers like you develop passive income and generational wealth through investments in the apartment and alternative investment spaces. Feel free to check out their website at www.oncallinvestments.com and subscribe to their free educational email series. You can find On Call Capital on Facebook, Instagram, and Twitter. You can also check out our YouTube page, where you'll find all of the show episodes along with other educational videos. Thanks for listening, and we'll see you on the next episode.